If you are engaging with the markets in any meaningful way, you have certainly heard the oldest financial advice in the book.
Oh, yeah. Don't put all your eggs in one basket.
Exactly. That simple cliche is supposed to capture the essence of investment diversification. But as we see every time the market panics, simply owning two different stocks just isn't enough.
That's right. True investment resilience is, well, it's far more sophisticated than simply ticking off a list of different assets.
It's about intentional choices.
It is. It comes down to intentional choices, deeply understood mechanisms, and scientific criteria. Today, we are diving into a stack of resources focused not just on diversification, but on building portfolios based on complementarity.
And that is the mission for you, the listener. We want to move you beyond that basic definition to understand the fundamental mechanics behind building a truly robust, risk-managed portfolio.
A portfolio that performs when everything else might be failing.
Yeah. Our guiding principle for today comes from the great investor Howard Marks, who wisely said, "Diversification is the art of not depending on a single bet." And that's what we're focused on in this deep dive.
And as we unpack these concepts and, analyze the research, we should probably state very briefly that this is all for educational and informational purposes.
Of course.
We're sharing experience and analysis from our sources, but we're not providing personalized investment advice or guaranteeing results. You are solely responsible for your own investment decisions.
Okay, so let's unpack the core mechanism of how true diversification actually works. It's not about achieving some kind of constant, smooth return.
No, not at all.
It's about making sure that when stress hits the system, not everything falls at once.
Wow.
We're looking for assets that function differently under pressure.
We call these decorrelated assets, investments that evolve in opposing directions when the market system is under strain. The whole goal is to find assets whose function is complementary to your riskier holdings.
I think the most vivid examples of this come during, moments of financial crisis.
Absolutely.
When there's a massive drop in the equity exchange, people flee risk en masse. They're seeking preservation, not growth.
They often rush toward what we label a safe haven asset. Historically, this has been precious metals, most commonly gold.
Right.
So if the stock market drops, say, 20% due to a crisis, the complementary function of gold is to rise, or at least hold steady.
Balancing the whole portfolio.
Exactly. It thereby balances the overall decline. Gold is decorrelated. It operates as an insurance policy when risk assets are being liquidated.
And this isn't only about systemic crises, right? We see the same push and pull dynamic when central banks adjust monetary policy.
Yeah, say when they raise interest rates to combat inflation, this completely shifts the calculus of risk and reward.
How so?
Well, when interest rates rise, the yield on bonds, which are basically long-term loans to states and companies, that also increases.
So they become more attractive.
Incredibly attractive. Suddenly, you can achieve a similar, maybe even a superior return to stocks, but with significantly lower risk. This just decreases the appetite for riskier equities, and their price action diverges from bonds.
So the objective of this whole dynamic is never just safety. The objective is true asset compensation.
That's the word, compensation.
If the risky part of your portfolio, the growth engine of that declines, the complementary low volatility parts of your portfolio should be providing that buffer.
Managing the overall risk exposure and volatility, that compensation is key to true resilience. I mean, if you're constantly losing 50% across the board during a downturn, you have correlation, not diversification.
You have a disaster.
You have disaster.
Yeah.
You want a mix where a loss in one area is offset or at least muted by stability or gains in another. That's the functional definition of complementarity.
Okay, let's move from those broad categories to the architecture itself, because holding a mix of gold, stocks, and bonds isn't enough in the modern world.
No.
Our sources emphasize that diversification needs to be viewed through a more comprehensive framework. Specifically, 6 criteria you must address to spread risk strategically.
This is where portfolio architecture requires real precision. If you skip even one of these layers, you expose yourself to a specific type of risk that complementarity alone just can't fix.
Okay, so number 1 is the broadest, and it's the one most people think of. Asset class.
Right.
Diversifying across different primary classes like stocks, real estate, commodities, and fixed income. The goal here is exposure to different fundamental economic drivers.
Number 2 is risk level. This means choosing assets with varying inherent risk profiles. You have to balance the high-risk, high-reward bets, say volatile growth stocks, with more stable, lower-risk holdings.
Like real estate.
For example, owning diversified real estate usually comes with lower inherent volatility than a concentrated equity position. You really need both ends of that spectrum to manage the velocity of your gains and your losses.
Okay, so criteria 3 and 4 seem to focus more on how the macro environment impacts everything. 3 is geography.
It sounds obvious.
It sounds obvious, but it goes deeper than just buying a few international stocks.
Hmm.
If your entire portfolio is tied to companies based solely in one geopolitical region, you're subject to a single political regime, a single currency crisis.
Or just one local economic slowdown. Spreading your investments across continents is a crucial mechanism for protecting against that sovereign risk.
But here's the rub on geography that I found interesting. In a globally connected economy, a multinational US-based company might earn 80% of its revenue in Asia.
Exactly. So simply looking at where the company is listed isn't enough. True geographical diversification requires looking at where the sales occur, and that leads directly into criterion 4, sector.
Right. Even within one asset class, you need variety. Look at the real estate example our sources mentioned. You could diversify within real estate by holding residential apartments, commercial offices, or specialized properties like medical facilities. A recession might crush demand for commercial offices.
But medical facilities, which are driven by demographics, are likely to remain stable. The sectors react differently to the economic cycle, providing that insulation.
Okay, so what's number 5?
Criterion 5 is size. This means diversifying company size. Small enterprises versus large, established companies.
Small cap versus large cap.
Yep. And this is particularly important because small cap companies are often driven by domestic growth and idiosyncratic factors, while the large cap holdings you see in major indexes tend to be highly correlated with one another, especially during periods of market instability.
So you need both.
Exposure to both captures different growth dynamics and stability characteristics.
And the final dimension, which is pure structural risk management, and I think often completely overlooked, is providers or platforms.
This one is so important and so easy to forget. It's not about the assets themselves, but how you hold them. If you invest through life insurance platforms or brokerage houses, it is simply prudent to use 2 or 3 providers rather than depending entirely on a single operational structure.
I mean, technology fails, companies merge.
Exactly. And having multiple custodians reduces that single point of failure risk. 6 layers of protection, all designed to ensure that when one specific type of risk materializes, be it geopolitical, sectoral, or simply platform failure, the other 5 layers provide a functional buffer.
So we've established the structural and mathematical rules of risk spreading, but I think we all know those rules are worthless if we can't follow them. And that brings us to the hardest challenge, the behavioral paradox and the importance of holding liquidity.
That's a powerful point. Cash, or keeping cash reserves, is often mistakenly viewed as a drag on performance.
It feels wrong.
It does. But strategically, it is one of the most important components of true diversification.
But why? Why would you keep cash earning almost nothing when you could be investing that capital and earning potential gains?
The why is precisely the ability to execute on these principles of complementarity we've been talking about. Holding liquidity allows you to take advantage of market crises. When the market has dropped 30% and everyone else is paralyzed by fear, the crisis presents genuine long-term buying opportunities.
Yeah.
But you need dry powder liquidity to capitalize on it.
Here's where investment gets deeply counterintuitive, because it forces you to fight every single one of your instincts. You should be buying when others are afraid, fearful, and selling massively.
You are buying their fear.
Yes. And conversely, you have to hold back when everyone else is feeling euphoric and rushing to buy. That point when prices have already skyrocketed and the risk-reward ratio is profoundly skewed against you.
This emotional paradox, buying fear and selling greed, is what separates those who build durable portfolios from those who constantly chase trends.
And that leads us perfectly into the advanced research we synthesized, which scrutinizes the exact definition of decorrelation. We've established that diversification requires all these criteria, but is simply finding assets that haven't moved together in the past enough for the long term.
That raises a critical question about statistical modeling, and it's the focus of the 2023 study by Narayan and Raman. Is a correlation-based investment strategy beneficial for long-term diversification?
Tell us about their scope. That sounds like an enormous undertaking.
It was indeed. The researchers analyzed 5 regional portfolios: Asia, Central and Eastern Europe, the Middle East and North Africa, and Latin America.
And the timeline.
It spanned over 2 decades, from 2000 to 2022. So this covered everything from the dot-com bubble to the global financial crisis to the COVID shock. They used advanced econometric models, specifically co-integration and vector error correction models, or VECM.
Okay, for our listeners who might not be specialists, what exactly are those models designed to show?
To simplify, they're sophisticated mathematical tools that look far beyond simple monthly returns. They're designed to see if different asset groups are tied together by fundamental economic forces over decades,
So the long-run relationship.
the long-run structural relationship.
Yeah.
And they tested their findings while also factoring in critical external variables like oil prices, S&P 500 performance, and broader investor sentiment.
That's why the results are so compelling. So what was the central warning based on this really comprehensive long-term view?
The warning was definitive. Diversification based only on low historical correlation, just looking at backward-looking numbers, is not always effective in the long term.
Really?
Yeah. Their data showed that when markets are stressed systemically, the correlations between historically decorrelated assets can suddenly converge.
So the mathematical safety net disappears precisely when you need it most.
Exactly.
If all assets start moving in lockstep during a crisis, what's the solution? How do you maintain true complementarity?
The authors argue for a balanced approach, one that specifically integrates assets that offer intrinsic fundamental protection against macroeconomic shocks. They highlighted raw materials, commodities, and emerging markets as crucial additions.
Why those two specifically? What's the fundamental protection they offer?
Well, commodities, like copper or agricultural products, often hold their value or even appreciate during inflationary periods when bonds and growth stocks are struggling.
And emerging markets.
Emerging markets, while volatile, are often less correlated with the specific cycles of developed economies. They're driven by different growth trajectories, different local pressures, giving them inherent complementarity when the developed world is struggling with, say, debt or monetary policy shocks.
So what does this all mean then? The study validates the multi-asset and geographic approach we discussed, but it introduces a crucial caution against over-optimization.
Yes, over-optimization based purely on backward-looking correlation data. The statistical past is just a poor predictor of the functional future.
It reinforces this idea that true diversification relies on the complementarity of assets, how they inherently respond to different macroeconomic environments and shocks.
Not just a statistical figure derived from a moment in time, complementarity is forward-looking resilience.
The ultimate objective, reiterated throughout all of our sources, is really straightforward. Reduce risk by intentionally spreading your investments across environments, asset types, and geographies.
To summarize the key takeaways you should implement, diversify by class, geography, sector, and company size. Add genuinely decorrelated and complementary assets like gold, bonds, and commodities to your mix. And remember that this complex, multi-layered diversification is the key to portfolio resilience. It should never be neglected.
We brought up Howard Marks earlier, and it feels wise to close with the wisdom of the late, great Charlie Munger. He said, "Take ideas where they are, but use your own brain to assemble them." That means the crucial next step is to do your own research, or DYO, based on your personal goals, your specific time horizon, and your unique risk tolerance. Our deep dive provides the framework and the research, but your situation is yours alone to structure.
And since we've established that past correlation is not a long-term guarantee and true diversification requires complementarity, let me leave you with this final provocative thought.
Go for it.
If you look at your current mix of assets today, what specific unexpected economic shock in the next 5 years, one that you haven't yet factored in, will truly test the resilience and complementary function of your holdings?
Something to think about as you review your portfolio architecture this week.
If you found this deep dive valuable and gained new knowledge about the mechanisms of true portfolio resilience, please hit the like button and subscribe to the channel to make sure you catch our next deep dive.